What's good, everybody? Hope you guys are doing good. So today I'm going to be going over 5 companies that are cutting dividends May 2020 part 3. Okay, let's go. Alright, stock number 1, we got the Foot Locker. I'm sure a lot of you guys, just like me growing up as a kid, the Foot Locker was the place to be. They had the best sneakers, the Jordans, Vans, Nikes, whatever you're looking for, the Foot Locker has had them in stock. Now, Foot Locker has been around since 1980. That's a long time. As you can see, their stock has been decent. It's dropped, it's gone up. It's dropped, it's gone up. It's dropped, it's gone up. And then, as you guys can see, in the mid 2010s, it just spiked all the way to its peak. It's around $70, and then it just dropped to $31 in 2017. And currently it is trading at $26. And currently it is trading at $26. Now, over here, Foot Locker falls by over 8% on Q1 reports dividend suspension. The company has been hit especially hard by the bug-related economic slowdown. Alright, as you guys already know, the retail industry is struggling to survive in the face of this bug. And the latest growing set of examples is athletic apparel and sneaker specialist Foot Locker, the stock price of which dived after the company posted its Q1 fiscal 2020 results on Friday. Let's look at the numbers here. Sales came in at just under 1.18 billion, down a steep 43% from the same period last year. Comparable store sales drops by roughly the same percentage. In terms of profitability or the lack thereof, the retailer swung to a loss of 70 million or 0.67 per share. Q1 2019 result was a net profit of 173 million. Alright guys, so basically Foot Locker is getting destroyed. Most Foot Lockers are located in malls or outdoor shopping centers, and even online shopping. Right now people just don't have a whole lot to spend on things that aren't really essential, so this is not a surprise that they dropped. Now let's take a look at the numbers, guys. How was their dividend doing prior? They've been paying since 2004, and this chart is a nice chart. From 2008 to 2011 they kind of stalled, but they've been raising this thing every year, so that's not bad. Like I said, this chart is a decent looking chart. If I didn't know what the company was, I'd say, okay, off of this chart I might look into this thing. And yeah, as you guys can see on the side, it just has been going up since 2003, and the latest was about 40 cents a share until they cut it. Now, Foot Locker is a mid-cap. They got 2.8 billion. However, again, their dividend growth numbers are pretty decent. Last year they grew at 10%, last 5 years 12%, last 10 years 10%. Again, the chart is pretty solid. However, as we know, and their financials were decent. It was not horrible, guys. It was actually in the right direction. However, once the bug kicked in, malls were shut down, sales tanked, and unfortunately that is why Foot Locker has suspended dividends. Quick disclaimer, I do not own Foot Locker. I don't plan on owning Foot Locker, and this is one that I will be skipping. On to the next one. Alright guys, the next stock we have is Ross. In case you guys are not aware, Ross is a department store, usually at a pretty high discount compared to most places. Market cap is 33.3 billion, so that's pretty big. They closed at $93 per share. 52-week low was $56, and their high was at $124. They have been around for a long time, guys, since 1985. They really started to see growth in about the mid 2000s to late. They just started to grow and drop and grow and drop, and then they peaked early 2020, guys. So only a few months ago, this stock was trading at all-time highs, and then once the bug it just crashed. Look at that. That is a drastic crash, guys. And ever since then, they've kind of just been holding steady. Now Ross, in case you guys don't know, is also a Dividend Aristocrat, meaning they paid consecutively for a good amount of time. Now, let's get some more news. Ross Stores late Thursday announced suspension of quarterly dividend. Alright guys, so the headline reads, Ross Stores late Thursday announced suspension of quarterly dividend. Let's look over at the chart over here. Since 1996 they've been paying. From 2000 to 2006 it was stagnant, and then from 2008 they just grew it every single year. This is nice when they're paying it, but it's not really that big of a dividend yield. It's only 1.21%. See, that's not a whole lot. But yeah, like I was saying, they are a large cap. And now let's look at their dividend growth history. Last year it was 13%, last 5 years 20%, last 20 years 23%. Very fast, very fast, very fast. And yeah, they were looking like a decent company to invest in. However, once the bug kicked in, Ross just basically tanked, and now the dividends cannot suspend what they're trying to do. Disclaimer, I do not own Ross. I don't plan on owning Ross. And that's about all I gotta say about Ross. On to the next one. Alright guys, the next company on my list is TJ Maxx. So for those of you who are unaware, TJ Maxx is an American multinational off-price department store corporation. It's similar to Ross. It's a department store, a discount department store I should say. Now, their chart kind of looks similar to Ross. In the beginning, took them a while, and then mid-2000s, they went back up, and they've been growing pretty much ever since. Their chart looks pretty decent. Again, guys, this chart looks good too. Market cap of 64 billion. That's right. That's 64 with the B, guys. Billion. They're worth a good chunk amount of money. Now, right now, it's $53. Their low was 32 and their high was 65, and their yield was only 1.72, which is not that great, but they were growing it from what I saw, and I'll show you guys in a link in a little bit. So right here, TJ Maxx company suspends dividends. It appears that TJ Maxx company suspended their dividend payment, so they're gonna be putting it on suspension for now. And right here, okay guys, this is a good point. This guy makes a good point. The most interesting fact is TJ Maxx actually raised its dividend on February 26th. The company announced a 13% hike to 26 cents a share, payable in June 2020. This marked the 24th consecutive year that the company raised a dividend. So they were also a Dividend Aristocrat. Okay, now let's continue here. And basically, we already know, guys, they don't have the money to spend. People aren't spending. So the rent, the employees, there's a lot of costs to operate a retail store. Now here's our dividend chart, and like I said, it's very, very similar to Ross. As you guys can see, about the mid 2000s to the late 2000s, they started paying dividends regularly. They kept increasing it. Again, this looks solid, guys. However, does TJ Maxx have a strong moat that separates itself from all other competitors in their category? You decide. As you guys can see, 64 billion large cap. Now here's an important note. TJ Maxx officially suspends dividend but continue to resume payments once conditions stabilize. They're committed to it. And this was only a few days ago. So they reported earnings on Thursday and suspended its dividend through at least the second quarter. Off-price retailer closed all of its stores and online business in mid-March, resulting in an unprecedented decline in sales and cash flow. Once this whole bug situation took over, guys, only essential retail was able to stay open, and this is why TJ Maxx and Ross had to take a cut for the meantime until things stabilize. And one thing too, guys, I'm just gonna make a prediction here. We are currently in May 2020. Here's my prediction. With everything happening, I don't know if it's going to work out to where clothing stores, if people are going to just try on the clothes like before, or they have to take it home and try it on at home, and then if they don't want it, they return it and they can't resell it. It's going to be very, very interesting, guys. This whole situation is probably going to change the way these stores are going to operate going forward. We'll have to wait and see, but my prediction is it will be something along those lines to where it's not going to be like before where you just walk in and you try something on and you walk out. People are going to be paranoid, and they might even put the clothing in like a plastic wrap to show that, hey, this thing hasn't been worn. And if it's been taken out of the bag or it's been broken, you know that it's been worn. They're going to have to do something like that because people are in a panic at this point in time. On to the next one. Alright guys, and the next company that we have here is going to be Molson Coors Beverage Company. The Molson Coors Beverage Company is a multinational brewing company founded in 2005. It is the world's 7th largest brewer by volume. So if you like beer, this is probably up your alley. So right now it's at $37 a share. The low was 34. Its 52-week high was 62. A market cap of $8 billion, which is not that big. It's about mid-cap. Alright guys, so they've been around since 1980. And they've been pretty consistent, and then once the 2000s came along is when they started to grow. So it took them about 20 years or so. As you can see, it went up, it dropped, it went up, it dropped, it went up, it dropped, and then the 2010s I should say, it just went sky high to its highs, and then after 2016 it just dropped again. Alright guys, and this is their earnings call. I will make a confession, guys. I have not ever read a company earning call, nor have I listened in on one. However, it's something that I plan to do because it is very, very, very important, so you know what the heck is going on. And if you really want to look into a business, you gotta figure out what the hell, you gotta know everything about them, what's going on, what they're doing, all that good stuff. However, as you can see, a part of it, they talked about the dividend, potential cuts or suspension to it. Somebody asked a question, and they finally answered, which says right here, we're having discussions with our board evaluating our capital allocation, which, as we've said in our remarks, does not include, or it does include a suspension of reduction or simply elimination of dividend, and we will of course communicate it due to key capital allocation, and we can confirm it here. Okay, Coors suspends quarterly dividend, furloughs employees. They have employees in Europe and North America. Okay, and we continue on here. They cut capital expenditure by about 200 million. All right, so there you have it. That confirms it. Now let's check out their stock dividend payment that they had. They paid it in 1995. Took a while, and then once the mid 2000s came in, they raised it, stagnant for a couple of years, raised it, stagnant, raised it, and then cut it. It looks decent. It's decent. Now over here, as we said, they have a market cap of $8 billion. Their dividend was deemed unsafe. 20% dividend growth. Last year, last 5%, 6 years, last 20 years, 9%. So they've had fast growth. And here's the chart again to show you guys. It's been growing at a decent pace. 28 years, with 28 plus years without a dividend cut. Again, guys, these massive companies are not immune to what we are currently dealing with at the moment, and this makes sense, guys. People are not going to bars and drinking. Where do you think they make all their money from? Bars. Bars make a ton of money. So it only makes sense why they have to suspend in the meantime and furlough employees, unfortunately, just so they can get through their situation. On to the next one. Alright guys, and the last company today is Halliburton. Okay, let's go over Halliburton. They are a drilling oil and gas wells company. Currently, they're only trading at $12 a share. They've been around since 1980, so they're basically back to 1980 levels, guys. Quick disclaimer, the reason why I don't sound too good is because my stomach hurts, guys. Okay, I'll be honest. My stomach hurts a little bit because I gotta keep it real with you guys. I own Halliburton stock. Okay, I know. You can't win them all. You have to take a loss sometimes, okay, guys? Sometimes you just take the loss. I know. So, their 52-week high was $25. Their low was $4. They've been growing decently. They dropped in the early 2000s, and then once again, the mid-2000s, they went up. And then once the Great Recession kicked in, this thing dropped, and it went up, and it dropped, and went up, and it dropped, and it went up, and dropped, and it dropped, and it dropped, and then it basically is almost at their lows of all time. Now here's the thing, guys. I did not put too much in Halliburton. They're not one of my higher companies that I'm allocating anything to. They just had a very, very small role because oil and gas, it's in demand. Most of these companies, a lot of these companies here, guys, I have some stakes in. I like them, and they were the latest ones to cut their dividend. Halliburton cuts its dividend. Why the stock is rising? Halliburton became the latest energy company to cut its dividend on Wednesday. This is May 20th when this article was posted, joining fellow oil services provider Schlumberger in slashing its payout by 75%. The dividend is dropping to 18 cents per share from 72 cents, while the stock's dividend yield will fall from 6.5 to 1.6. Yeah, guys, that definitely hurts. Oil companies around the world are cutting their capital expense, leading to too much lower revenue for service firms. So here's a key part of it. Halliburton is vulnerable, particularly because those cuts are focused more on U.S. drilling, and they blame the cut on the current market condition and uncertainties regarding the depth and duration of the downturn that we have been experiencing, and they've already cut capital expense by 50% and reduced executive compensation. Following its annual meeting, the board also announced 20% cut to the retainer paid to company directors. Now, their dividend has been getting paid since 1996. It had not the best chart, guys. I'll be completely honest. Their chart is not that good. It's okay, but it's not that good. Like I said, this was more of a speculative play for me, but this one has taken a hit. As you can see, their dividend safety score, very unsafe. Dividend growth last year, 0%. Halliburton's dividend on shaky ground as management prioritizes balance sheet. As we continue, guys, last year very slow, last 5 years slow, last 20 years average, but they were 29 plus years without a dividend cut. Alright, guys, so what is the moral of the story today? We have to take away and learn something from this. Just because a company has been paying dividends for a very long time does not mean that they will be able to survive any type of economic downturn. Okay, that's what we have learned today. Also, just because a company has a decently large market cap, they've been around for a long time, their charts look okay, you never know what's going to happen, guys. So there's always a risk. Again, this is not financial advice. I'm not advising you to buy anything. This is all for your fun and entertainment. Talk to a professional in your area so that he or she can give you the best advice depending on your financial situation. Alright, literally, guys, this is just for entertainment purposes. I have a lot of fun making these videos. I got a lot of fun looking at charts and deciding what to do to make my future a little bit brighter for myself. Okay, things that I think might help me. Do your own research. And that's about it for now. As always, if you're not subscribed, don't forget to subscribe. And if you like the video, don't forget to give it a like. Until next time, peace.